If you do not know how to identify real institutional supply and demand zones, the market will keep baiting you into weak setups and false reactions around support and resistance. In this video, we are going to show you exactly how professional traders use a liquidity trading strategy, price action, and concepts like order blocks to identify high probability zones and understand how the market really moves. You will learn 15 practical rules based on a proven supply and demand liquidity strategy. Apply this framework step by step, and you will begin to see the chart with the same logic used by stock market successful traders. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before we move into the core framework of this video, I want to share 3 powerful principles from David Paul. These are not just technical rules. They are practical insights developed through real market experience, and they will shape the way you think about execution, timing, and positioning.
Rule number 1, the good trade is a hard trade. You know who taught me that? A delightful old man. He was one of the first market wizards, Michael Steinhardt. Do you know him, Larry? I know him so well. He's 90 these days, 91. He's still trading. My word, he's made a hemp. He trashed those indices for 25 years. And he was the inspiration for me, in fact, buying oil right at the lows. That was a classic Michael Steinhardt trade. And please Google Michael Steinhardt. He was one of the original market wizards. He has got cast iron you-know-whats in his day. He was something. Guys, the good trade's a hard trade. I'm not saying it's intellectually difficult, okay? In fact, as I said on Friday, the thicker you are, the better. But it's just difficult to do. The market's roaring down, 3 big red bars. Puts the fear of God into you, and now some idiot tells you you must step in and buy it. You know, it's really, really difficult. Okay? Very difficult to do. So that's a characteristic of a good trade. If the trade seems easy, there's a good chance you're just about to be sexually violated. And that's fine if you like that sort of thing.
Now, this idea is extremely important. The best trades often feel uncomfortable in the moment. And that discomfort is not a sign that something is wrong, but rather a signal that you are stepping outside of emotional bias and into structured decision-making. Most traders avoid these situations because they feel uncertain or risky, but in reality, those are often the moments where the best opportunities exist. The market rarely rewards comfort. It rewards discipline, patience, and the ability to act when others hesitate. That is why building trust in your framework is essential, because without it, emotions will always take control at the worst possible time. Let us move to the next one.
Rule number 2, I want to fade the short-term trend in the direction of the long-term trend. So fade the short-term trend in the direction of the long-term trend. So what I'm saying is that I've got a long-term trend in place and I want to buy a pullback and let it go again. Guess what that is? A, B, plus it's C, D. Okay, so I wonder where I got that from.
What he is describing here is the alignment between time frames, and this is one of the key elements that separates reactive trading from structured execution. Instead of chasing impulsive moves and entering late, you step back and allow the market to retrace into areas of value. By doing this, you are no longer trading noise, but positioning yourself in the direction of the dominant trend with intention and clarity. This approach removes randomness from your entries and replaces it with timing and structure. And that is where true precision begins to develop. Now, let us look at the 3rd rule.
The 3rd rule, I want to put my entries where the masses put their stops. How's that? On your way home, I want you to pass a building site. And on the building site, you pick up a brick. Okay? You take that brick home, and tomorrow when you're about to put on your first trade, you decide where you're getting in. Just before you press the button, you pick the brick up and you go. smack it against your head. That puts you into the present moment. And here's what I want you to do. Rather than buying the market at where you thought you were going to buy the market, put an order in at where you were going to put your stop and see how often the damn thing goes to your stop. Okay? So place your entries where the masses place your stops. And this is another thing I learned from Larry, is that the best trades occur when the masses have been stopped and trapped. So even if you don't get in at the cusp of the turn, if you can look back and see, just obvious on the chart, that lots of people would have bought there, and then the bloody thing went down again, nailed them, and then reversed. If you get in after those people have nailed, then you're in a much better place, okay? And of course, that's difficult because we're scared of missing out. At least I am.
This is one of the most powerful concepts in trading, and it changes the way you interpret every move on the chart. The market does not move randomly. It moves toward areas where liquidity is resting, and that liquidity is most often located at stop levels placed by other traders. When you begin to understand this behavior, you realize that price is constantly seeking these pools of orders before making its real move. This is the point where your perspective shifts. You stop reacting like the crowd, and instead, you start anticipating where the crowd is positioned and how the market is likely to move against them before continuing in the intended direction. Now that you understand these three principles, we can move into the structured framework. Rule number 4 is the break of structure. To begin with, this rule is very simple and easy to understand. The zone must be responsible for a clear break in market structure. Let us see how this plays out on a real chart. Imagine the market is in an uptrend, with price consistently forming higher highs and higher lows. Now, pay close attention. Price pushes higher and breaks above the previous swing high. This movement represents a clear break of structure and signals strong buying pressure in the market. So, what do we do next? Instead of reacting immediately, we look back on the chart and identify where that impulsive move started. That origin point defines our demand zone. This is the area where buyers stepped in with enough strength to break market structure. But here is the most important part. We do not chase price. Instead, we remain patient and wait for price to return to that zone. When price comes back, we observe how it reacts. If we see the right type of confirmation, that is our signal to enter the trade. And do not worry, we will explain exactly how to enter and which confirmations to look for in detail later on. Rule number 5 is the flip zone. A flip zone occurs when supply turns into demand or when demand turns into supply. These zones are especially powerful because they often lead to high probability trade setups. Let us move to the charts to see how this works. Imagine the market is in a downtrend with supply clearly in control. Price breaks structure to the downside and forms a new supply zone. After that, price pulls back into this zone and attempts to continue lower, but it fails to break the previous low. At that moment, demand starts to step in. Price changes direction, breaks structure to the upside, and continues moving higher. This is a textbook example of a flip zone. The key takeaway is to mark this area. If price returns to the zone and shows confirmation, it becomes a strong level to look for long trades. Patience matters here. Wait for a clear failure of supply and visible strength from demand. Rule number 6 focuses on sweep zones. Sweep zones are about identifying where large players are actively moving the market. Let us simplify the process. Price is trending higher, printing higher highs and higher lows. Then a pullback occurs and equal lows are formed. These levels are common areas where retail traders place their stop losses. Price briefly moves below those lows, triggering the stops and releasing a wave of sell orders into the market. But here is the key point. Price does not continue lower. Instead, it quickly reverses direction. The reason is that institutions are stepping in and using that liquidity to build large buy positions. Once price rallies upward and breaks the previous high, we have confirmation of strong demand. At that point, we mark the zone and wait for price to come back. When price reacts there, that becomes our entry signal. Simple in concept, but extremely powerful in execution. Rule number 7 is inducement. Inducement is a classic move designed to trap traders into poor entries before larger players drive price in the opposite direction. Here is how this appears on a chart. Price is trending higher, forming higher highs and higher lows. After that, a small pullback develops, creating a minor low. Early buyers step in and place their stop losses just below that low. Price then dips slightly below the low, sweeps those stops, and immediately reverses with strong momentum. This is the inducement move. Why does this occur? Institutions need liquidity to fill large orders without causing excessive slippage. That is why price often reacts so aggressively after inducement. The key lesson is simple. We do not enter zones blindly. Instead, we wait to see if inducement takes place. When it does, the probability that the zone will hold increases significantly. Rule number 8 is stacking zones. Stacking zones refers to aligning zones across multiple time frames to identify stronger areas where institutional activity is more likely. Let's look at a clear example. On the daily chart, we identify a demand zone where price initiated a strong upward move. Now, zoom into the 4-hour chart. Inside that daily zone, price creates another demand zone. This alignment forms a stacked zone, which is a strong example of confluence. When zones overlap across time frames, it often indicates a higher concentration of resting orders. As a result, price is more likely to react when it returns to that area. This is where we patiently wait for confirmation and then look for a precise entry. Rule number 9 is higher time frame alignment. Higher time frame alignment is extremely powerful. When multiple time frames point in the same direction, your trades naturally carry a higher probability of success. Begin your analysis on a lower time frame, such as the M5 chart. At first glance, price may appear to offer a clean sell setup with clear lower highs and lower lows. However, do not rush into the trade. Take a step back and zoom out to the M15 chart. You may notice that price has just tapped into a strong M15 demand zone that has not yet been broken. At that point, the structure on M5 can suddenly begin to flip bullish. The lesson here is critical. Always respect the higher time frame. When lower and higher time frame setups align, you are no longer trading a single pattern. You are trading in harmony with the broader flow of capital and time behind the move. Rule number 10 is optimal entry zones. This is where precision becomes critical. Instead of entering trades randomly inside a zone, we want to focus on where pullbacks are most likely to end. To explain this properly, we are going to use a short concept taken from another video on the channel, where we break down the ICT trading model in detail. You will find the full video linked in the description. This model is known as ICT's optimal trading zone and optimal trade entry. It is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. The goal is to identify the most efficient area for entry, allowing traders to enter with precision instead of chasing price or reacting too late. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range. The optimal trading zone, typically located between the 61.8% and 78.6% levels, highlights areas where institutional participation is most likely to return in the direction of the dominant trend. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-time frame confirmation, this model creates a clear and repeatable framework for high-probability trade entries. Rule number 11 is fresh versus mitigated zones. Fresh zones are areas that have not been touched, which usually leads to much stronger reactions when price returns. For example, a fresh supply zone is one that has never been traded into before. When price comes back for the first time, the reaction is often sharp and aggressive. Now, compare that to a zone that has already been tested several times. In those cases, the reaction tends to be smaller and weaker. The focus should always be on fresh, unmitigated zones, especially when they are combined with market structure and proper timing. Rule number 12 is emotional detachment from outcomes. This rule is about separating your identity from the result of a single trade. Most traders become emotionally involved with each position, and that creates pressure, hesitation, or impulsive decisions. A professional trader understands that no single trade defines success or failure. Each position is just one event in a long series of probabilities. When you detach from the outcome, you stop forcing trades, you stop interfering with your plan, and you allow your edge to play out over time. This is what creates consistency. Rule number 13 is execution over perfection. Many traders spend too much time trying to find the perfect setup, the perfect entry, or the perfect confirmation. In reality, perfection does not exist in trading. What matters is consistent execution of a proven framework. When you hesitate, overanalyze, or second-guess your rules, you break your own system. Professional traders focus on executing their plan with discipline, even when conditions are not perfect, because in the long run, consistency in execution always outperforms the search for perfection. Now, let us move into trade management. This is the part that transforms a good setup into a winning trade. We will begin with entries, because the way you enter makes a major difference when trading around supply and demand zones. There are 3 reliable entry methods that you can use. First is the limit order entry. This approach is very straightforward. You place a buy limit at a demand zone or a sell limit at a supply zone. The main advantage is that you secure the best possible price. The drawback is that there is no confirmation, which means higher risk, but also the potential for higher reward. This method works best when the zone aligns with the higher timeframe trend and shows a strong imbalance. That alignment is where this entry method truly performs at its best. Second is the change of character entry. This method provides confirmation before you commit to the trade. After price pulls back into your zone, wait for a clear shift in structure on the lower timeframe. That shift becomes your signal. Once it appears, identify the high or low that caused the structural change and enter at that level. Your stop loss should be placed just beyond that structure. This approach reduces risk while increasing the probability of a successful outcome. Third, and the most refined method, is the liquidity sweep combined with a structure shift. Here's how it works. Price takes out equal highs or equal lows, sweeping liquidity, and then quickly reverses. When that reversal breaks structure or creates a clear change of character, it confirms that institutions have entered the market. That moment is your cue to follow. They are effectively revealing where smart money is positioning itself. Now let us move into stop-loss placement, because risk management is critical in trading. If you are using a limit order entry, place your stop just beyond the extreme of the zone. This allows the trade enough room to develop without exposing you to unnecessary risk. If you are entering with confirmation, such as a break of structure or a change of character, you can tighten your stop. Place it just below the low or above the high that caused the move. This approach keeps losses small and greatly improves your risk-to-reward profile. Next, let us cover take profits. Keep this part simple and structured. There are 3 solid approaches. First, target the next opposing zone. This is the next supply or demand area where price is likely to react. Second, use a fixed risk-to-reward ratio, such as 1:3 or 1:4. This helps maintain consistency and discipline over time. Third, scale out of the position. Take partial profits early and allow the remainder of the trade to run. This locks in gains while still giving the position room to grow. When you combine precise entries, proper stop-loss placement, and clear take-profit rules, you stop guessing and start trading like a professional, where discipline turns strong setups into consistent results. Before we wrap this up, I want to share 2 additional rules inspired by insights taught by David Paul. These final rules are not about entries or zones. They focus on what determines whether a trader can stay in the game long enough for any strategy to work. Rule number 14 is position sizing and risk exposure. This rule is about how much you risk, not how good your setup looks. To illustrate why this matters so much, I am going to play a short clip where this concept is explained in a very direct and practical way.
In a 50% system, unfortunately, you get 2 bad ones every 4 trades. Ladies and gentlemen, if you were to bet 50% of your coins on any one trade, you go bankrupt every 4. Gets worse. For 8 trades in a 50% system, you have a cluster of 3 bad ones in a row. That means, ladies and gentlemen, that if you were to bet 1/3 of your coins on any one trade, you go bankrupt every 8. And most people go bankrupt because they bet far too much on any one single trade.
Position sizing is critical because losing trades are unavoidable, even with a solid system. The difference between traders who fail and traders who last is not the strategy, but how much damage a losing streak can cause. When risk is kept small and consistent, no single trade can define your outcome. This is how professionals protect their capital and give probability time to work. And now, finally, Rule 15 is presence and emotional control. This rule moves beyond risk and into decision-making itself. It is not about charts or structure, but about the mental state you bring to the market. To explain this properly, I'm going to play another short clip from David Paul that highlights why traders often act against their own rules.
We've got two brains. I'm sure you've all heard of the reptile brain and the front lobe brain. Well, I want you to think now, folks, that you're a summer's afternoon and the barbecue's going and kids are having fun playing football, right? And you're standing there. A ball comes out of nowhere. Football comes out of nowhere. What do? Duck. Yeah? Without thinking about it. Similar situation, but standing there Sunday afternoon and somebody throws a ball at you very slowly. What do? You catch it. Okay. So if somebody chucks a ball at you really fast, believe it or not, and according to this professor of psychology at UCT, there's a part of your brain that actually reacts, and it reacts up to half a second faster than your normal brain, this reptile brain, and its job is to keep you out of trouble. And frequently that happens in our trading as well, where have you ever done something dumb that you've sworn you'll never do again? Okay. And that's because that reptile brain is in fact trying to keep you away from danger. Not a lion about to hit you, but in fact emotional danger. And another example is that you're driving along a road and a dog comes out. Do you swerve? Yeah, you probably do. And you've said to yourself 1,000 times that I'll never swerve again. I'm going to drive straight. But in the moment, that reptile brain. So there's a part of you, if you're not present, folks, there's a part of you that's designed by the Almighty, or whoever you believe in, to keep you safe and well, away from physical danger, away from emotional danger. And if you're not present, you'll find that you keep doing really dumb things. So when you're sitting in your trading desk, it's really important that you're totally and utterly there. Not thinking about the past, not thinking about the future, totally in that moment.
Trading decisions are often made under pressure, and when awareness drops, reactions take over. That is when traders abandon their plans, hesitate, or act impulsively. Professional traders train themselves to stay present and grounded at the point of execution. When discipline, risk control, and psychological awareness work together, trading becomes structured instead of emotional. This is what turns good analysis into consistent performance over time. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.